Hello and welcome to this week's webcast. The FX option markets is in the doldrums. Exchange rates are fluctuating far less than in the past. Implied volatilities are at their lowest level since 2014. This is most apparent when data such as the US non-farm payrolls or the IFO business climate are published. At one time, every FX trader waited eagerly for these figures. The atmosphere among traders just before the data release was electric. Now, however, unless there is some massive surprise, results of this kind go almost unnoticed among daily trading. Why is this so? Earnings from FX positions result from interest rate spreads between two currencies. Interest rate expectations are the real driver of exchange rates. Yet the central banks look at current low inflation and are barely moving their interest rates. The ECB in particular will be sticking to its policy of negative rates for quite a while. True, the Fed has started to raise rates, but compared with the past, it is moving very cautiously. It's the central banks above all who are responsible for the low volatility on the FX market. But this situation need not last. The US labor market is close to full employment. Sooner or later, wage growth will accelerate. Once core inflation reaches a Fed target of 2%, the bank will be less hesitant in raising rates. We would then see more movement in the expected interest rate spreads and exchange rates. I don't know when exactly the market will again bet on rising inflation expectations. But the present very low implied volatilities at least tell us that it's not a bad time to hedge against FX risks. Thank you for listening, and I hope you enjoy reading our Week in Focus.